Speaking of what could affect the economy, Vice President Joe Biden says that tax cuts for the wealthiest Americans are, quote, morally troubling, which is why one of the Obama administration's new goals for 2012 is to end them. Well, Dan Mitchell, a senior fellow for the Cato Institute, has a different opinion. He wrote a recent op-ed piece titled New Tax Deal, The Good, the Bad, and the Ugly. In it, he says the deal between congressional Republicans and President Obama is less than ideal, but is better than what he had expected. He joins us now from Washington. Dan, good to see you.
Thank you.
All right, well, let's get started right here. I mean, why don't we start off with the positive side of this, the good, so to speak, of what was recently passed?
Well, the good news is that we're not going to have higher tax rates next year. That means entrepreneurs, investors, small business owners have a little bit more of a stable environment in which to plan and hopefully increase output, create jobs. But I don't want to oversell this, because all that's really happening is that we're not increasing tax rates next year. So it's not like the government's doing something good for us. They're just not doing something bad to us.
Right. This was really, we talked about this quite a bit. We covered this quite closely. This is a 2-year extension of the 01 and 03 tax acts, which was something that we thought was going to go away entirely. And that includes, as part of it, was lower tax rates on capital gains and dividends. So good in terms of being, I guess, encouraging investment. And then there was also a payroll tax cut that was put in place of the Make Work Pay tax credit. And I think that this is one thing you're quite positive about, is that the death tax rate was held at 35% for the next 2 years.
Well, it depends whether you're an optimist or a pessimist. The bad news is that we're going to have a 35% death tax next year instead of 0% this year. So if you have a lot of money, you only have, 10, 11 days to die. You better get moving on that. On the other hand, if we had done nothing, we would have gone back to a 55% death tax on January 1st. And frankly, I was expecting a 45% death tax as a compromise. So the fact that it's 35%, that's still 35 percentage points too high. It's bad policy to have any sort of double taxation on saving and investment. But compared to what I thought we were going to have, I guess I'm somewhat happy.
Now, let's quickly go through the bad here. One of the things I know that you outlined in this op-ed piece was that you don't think the extension of unemployment benefits is good for anyone.
Well, there was just a study earlier in the year from the San Francisco Federal Reserve Bank pointing out that the extension of unemployment benefits has probably increased the unemployment rate by about 0.5 percentage point. Now, this is not unconventional thinking. Even left-wing economists like Larry Summers and Paul Krugman have written in the past that when you pay people not to work, surprise, surprise, some of them decide not to work. And that's, I think, exactly what's happening. And you would think that some of the people in the White House who actually understand this literature, they would realize that extending high levels of unemployment coming up to the 2012 elections, that's not good news for Obama.
Now, let me ask you this. Very quickly, the ugly that you point out, of the good, bad, and the ugly, are special interest provisions, which is something we see a lot in D.C., right, a lot of that. And then getting back to this notion of these being temporary, but I also want you to touch upon what this means for the deficit. You know, to what extent are these tax provisions that stimulative to the economy, and is it worth it in terms of the added cost to the national debt? You know, one estimate puts it at close to $900 billion. You can see the figure right there.
I'm a big believer in the Laffer curve, but the Laffer curve doesn't mean that lower tax rates pay for themselves. It simply means that you'll get some additional economic growth, which will generate some revenue to partially offset the revenue that's lost because of lower tax rates. So we will have more red ink as a result of this plan. But what we need to focus on is government spending, because government that's too big is the problem, and then deficits are simply a symptom of that underlying problem. I don't want to be Sweden, where historically they have surpluses, but government is twice as big, almost as what we have in the U.S. I want to get government spending under control, because whether politicians finance spending by borrowing or whether they finance it by taxes, in both cases they're diverting resources from the productive sector of the economy. We need to bring government down to less than 20% of GDP, which is where it was when Bill Clinton left office. Now we're at 25% of GDP. So in other words, the Bush-Obama years of big government have not been good for fiscal policy.
All right, Dan, thanks for giving us your synopsis. Unfortunately, we have to leave it there. I'd love to spend more time with you. I know you don't think that this sort of 2-year extension is really going to be stimulative to the economy in terms of GDP and lowering the unemployment rate. Dan, we'd love to have you back. Thanks for joining us. That was Dan Mitchell.
Thank you.
He's a senior fellow at the Cato Institute.